Hey, what's up, my friend? In today's training, you'll discover the best Forex trading strategy for beginners. And here's the thing, right? This trading strategy, it doesn't only work for Forex, it can be applied to stocks, the futures market as well. So, this trading strategy is what I call the BWAP trading strategy. The BWAP trading strategy. So, before I explain to you what this is about, right, I want to share with you the criteria, right, that went through my mind before I decided to share the strategy with you. Number one is that this trading strategy, the pattern has to be easy to spot because new traders, right, beginners, they are not familiarized with, price action analysis, chart patterns and stuff like that. So I made sure that this pattern is relatively easy to spot. So for new traders, right, they are able to, to catch this. Number two, there must be a sound logic to behind why this trading strategy works. In fact, for all strategy, right, there must be a logic behind why it works. If not, right, you won't have the conviction to trade it. And number three, this pattern, right, this BWAP trading strategy, it must take time, right, for it to happen. Meaning it takes time for the pattern to form. If it forms too quickly, beginners, right, they won't be able to catch it in time. They'll be too slow to react. So I made sure that this trading strategy, it takes time to form, so new traders, they can catch it as well. So the BWAP trading strategy, right, the long setup, right, goes something like this. The market is in a range, and ideally you want 80 candles or more. So don't have to be too, anal about this. If you get 77 candles, 75, it's fine as well. But generally, I just put here 80 candles or more. The more candles, the longer the range, the better. Number two, the price then approaches the highs of resistance and then forms a tight consolidation, otherwise known as a build up, right? So this is what I'm looking for, a tight build up at the highs of resistance. Number three, I want the 20 period moving average to touch the lows of the build up to signal to me, right, that the market is about to make a move higher. And number four, I place a buy stop order above the highs with a 3 ATR trailing stop loss. So if you don't understand, all these technical terms, don't worry, I'll share with you a ton of charts and examples, cherry pick ones, okay? I cherry pick it because it's much easier to illustrate those examples so you understand what this means. So as a rough idea, right, let me just sketch you how it looks like. So market is in a range over here, ideally about 80 candles range. Then it comes up to the highs of resistance and form a tight consolidation. So this one is what we call a build up, or what I call a build up. Then you want to let the 20 period moving average, which is this line over here, touch the lows of the build up. This signals to you that the market is now getting ready to break out. Then when that happens, you place a buy stop order above these highs, just above the highs of resistance. And if the market breaks out, you go long with a stop loss of 3 ATR as your trailing stop loss. So I'll explain how that works with a few charting examples. But first, right, the short setup is just the opposite. Market again in a range, 80 candles or more. You want the price to approach the lows of support and form a tight consolidation. Then the 20 period moving average, it touched the highs of the build up. And then when that happens, you place a sell stop order below the lows with 3 ATR trailing stop loss. So why does this trading strategy works? All right, so let me explain to you a few reasons for it. The first one here, okay, let me just draw this again. So when the market consolidates at the highs of resistance, this is a sign of strength. It's telling you that there are buyers willing to buy at these higher prices. Okay, it's a sign of strength. Or number two, it's telling you that selling pressure has difficulty pushing the price lower. Maybe there's a lack of seller. So whatever the case is, right, this is a bullish factor in your favor. Number two, the volatility cycle is in your favor as well. So I'll explain what this means. So here's the thing, right? The market, right? Volatility in the market, it's always changing. Volatility is not static. It's always, moving from a period of high volatility to low volatility and then back to high volatility again. So you can imagine this, that when you are entering your trade in this build-up environment, this is in a low volatility environment. And when the price breaks out and if volatility expands, right, what does that mean for you? That means that your risk to reward on the trade could be pretty darn favorable. If volatility expand, right, you can see that your risk to reward is pretty darn good over here. And this is what I mean by the volatility cycle is in your favor because you're entering in a period of low volatility. And the third thing over here is that there is a logical place for you to set your stop loss. You can just set your stop loss below the lows of this build up over here. right? Maybe just somewhere about here. There's a logical place. Compared to a trader who trade breakout, let's say a trader who trades breakout, there's no build up, he just simply buys this breakout over here. Where are you going to set your stop loss? If you ask me, right, the logical place, the nearest one is below this area of support, and it's pretty darn far away. Okay, so this is why this BWAP trading strategy works. And what does BWAP stand for? It stands for breakout with a build up. Okay, a breakout with a build up trading strategy, the BWAP trading strategy. So let me share with you a few examples so you know how the BWAP trading strategy works. And by the way, right, if you are enjoying this content so far, hit the thumbs up button. And if you don't enjoy it, right, then subscribe to my YouTube channel. So first thing first, if you recall, we are looking for a range, a minimum of 80 candles, 80 bars. So use this tool over here, just plot it from the start of the range all the way. And you can see that right now it has about 83 bars over here. Okay, oops, it's gone. Let me just do that again. It's about 80. Okay, if you see the red color box, there's about 83 bars right now. Okay, so that kind of meet our criteria. So where is the highs of resistance? So again, use your tool, horizontal line. I can draw this area of resistance over here. And the price, what is it supposed to do after that? The price to approach resistance and then to form a build up. So once it forms a build up, what's next? We're looking for the 20 MA to touch the lows of the build up. So we just pull out our 20 MA, and you can see that over here, right, the 20 MA has touched the lows of this build up, and it seems to be, supporting this higher prices. If you just zoom in, right, you can see that right now the price, seems to be supporting, right, like kind of supporting these higher prices. So great. So now our third criteria is met. The fourth thing to do is to place a buy stop order above this highs over here, the highs of resistance. And finally, we have a 3 ATR trailing stop loss. And you can use this indicator called the chandelier stop over here. Let me just remove the 20 MA, which is, you see, is this purple and blue line over here. This purple, this blue line. So how this works is that this is actually a variation, right, of the ATR indicator. So let me explain. So this one, the settings for this chandelier stop, right, after you place a buy stop order, you enter the trade. How do you manage the trade? Where is your stop loss? This is where this blue line comes into place, right? This is where our trailing stop loss is. So when the price closes below this blue line, we exit the trade. So the settings for this indicator is 122.3. You can use 123, it's fine as well. So ATR period is just simply the look back period. I mean the how many time period, right, that you want to use to calculate the ATR value. What is it? The last 20 days, the last 22 days, it's up to you. The important one is over here is the multiplier. I shared with you a 3 ATR because this would allow you to capture medium-term trend. If you want to capture a longer-term trend, you can just increase the ATR multiplier to like 4 or 5, whatever you wish. So how does this blue line move then? Very simple, right? Let's say now this is the highest price over here. Okay, and if you pull out the ATR indicator, which stands for average true range, it measures the historical volatility of the market. So let's say the ATR value right now is X. So what this indicator does is that we have a multiplier of 3. So X multiplied by 3 gives you 3X. Right? So let's say the current price now is, let's call it, I don't know, Y. Okay? So Y minus 3X, which is the 3 ATR. It gives you, let's say, Z. So Z over here is this blue line over here. This is simply, right, from this price, you minus 3 ATR gives you this blue line over here. So you can imagine that as the market price goes up, your blue line, your chandelier stop, right, will increase as well. Okay, and this is what happens as the market goes up higher, your blue line goes up as well. And you only exit the trade when the price closes below the chandelier stop, which happened over here, right? This candle, it closes below this blue line and you exit the trade. And yes, this is a winning trade, and yes, I cherry picked this, and that's because it's much easier to illustrate a concept, right, when it's a winning trade compared to a losing trade. But don't worry, right, I'll share with you loser as well to kind of manage your expectations. So this is how the BWAP trading strategy works. Moving on, one more example. New Zealand yen. Okay, let me walk you through step by step again. Step by step with no step missed. Ooh. Okay, so again, this one over here, first thing first, we are looking to identify a range. At least 80 candles. So Okay, we just use this tool. You pull out from the start of this range till the end of it. You can see that right now it's about 77 bar. Oh, Rayner, it's not yet 80 bars, man. Can we take this setup? There's only 77 bar. Come on, don't be anal, right? If it's 1-2 bar difference, 5 bar difference, just go with it. The concept is what matters, not the exact, setup or whatsoever, right? The concept is what matters. So right now we have about 77, 78 bars. That's fine as well. Okay. Next thing. Identify the highs of resistance, and I see it somewhere about here. Okay, you can see that this market is in a range, and that's the highs of resistance. Third thing, the build up. Okay, over here, there is the build up over here. So now, on hindsight, it's going to be damn easy to look for build up, but in real time, this is where things get tricky. So let me just, bring you back in real time and imagine this at this point in time. This over here, right, you might think that a potential build-up is forming already, and you might be anxious, right, to simply buy the breakout of these highs. But remember, you only want to enter the trade when the market is getting ready to break out. And how do we know when the market is getting ready? So that's where the 20 MA comes into play. When the 20 MA touch the lows of the price, all right, for that to happen, right, the market has to consolidate for a period of time. That means the build-up, right, has to last for a while. So right now, if you pull out the 20 MA, you can see that the lows of this pullback, the lows of this build up is quite a distance away from the 20 MA. So this tells you that nope, the time is not yet ready. You want the 20 MA to touch the lows of the build up. So if you go forward in time, over here. Now, the 20 MA has touched the lows of the build up. Now, we can conclude that this market is getting ready to make a breakout. And that's where we place our buy stop order above this highs. And then 3 ATR trailing stop loss. Okay, in this case, right, market breakout higher. After a while, you can see that it forms a build up for a while, then finally it broke out over here. So yes, the market did chop the 20 MA for a while, but it doesn't really matter. The main thing that we are looking for is for the build up to be nice and tight. The tighter it is, the better. And when the market breaks out, again, we summon, right, the chandelier stop. We are using 3 ATR, which is this one here, this blue line, and this blue line will move as the price moves higher, right? It's moving in tandem. So as the market goes up higher, this blue line goes higher, and you only exit the trade when the price breaks and close below it. So if you look at this, at this point, the market has touched the blue line, but it did not close below it. So you'll still stay in the trade until it closes below it, which is at this point over here. Okay, so you can see that when it breaks and closes below it, right, the whole thing will kind of distort, and you know that it's time to exit your trade. Okay, so this is New Zealand yen. Another example, euro dollar. Okay, so if you just look back in time. So again, what's the first thing we're looking for? Range market, at least 80 candles. And again, right, I don't have to draw that out. You know which tool to use. Then identify the highs of resistance. Then, okay, if you look at this example, this is a little bit different because you notice that the build up is actually formed outside of resistance, right? So the earlier examples, the build up will form before resistance, before it broke up. But right now, it seems to hit resistance first, break out of resistance, and then it forms a build up. And that's fine as well. This is fine as well. So again, next thing we're looking for is for the 20 MA to touch the lows of the build up. At this point, you can see that the 20 MA has not touched the lows of the build up, right? You see over here, lows of the build up is somewhere here. 20 MA has not touched it. So it's not ready to break out yet. So we let it touch the lows of the build up. Over here, it did touch. Okay, over here. And finally, you can place a buy stop order above this highs, and then use 3 ATR as our trailing stop loss to ride the trend. So what's the outcome for this trade? Winner or loser? Well, to be honest, it doesn't matter. The concept is what matters. The process is what matters. So no results for this one. Move on, next one. Dollar against the Turkish lira. So again, same concept, my friend. So again, where is the range? Okay, I see the range over here. This is the highs of resistance. Next thing we are looking for is the build up, right? The range, ideally, you want to have at least 80 candles. Then you want to let the price approach the highs of resistance, which is this one over here. Then you want to let the 20 MA touch the lows of the build up. So let's see if that happens. So let me just zoom in and we slowly analyze. So at this point, 20 MA has not touched the lows of the build up, and so we don't enter yet. So at this one over here, I can see that over here, this candle is pretty close already. So it's a kind of like a little bit of a subjective call whether you want to consider it as a touch, right? It's pretty close already. So whether you consider it a touch or not, I leave it to you. Okay, and then if you consider this a touch, right, then what you can do is just simply place a buy stop order above this highs or above this highs. Couple of options here. And if it does trigger, you then use a 3 ATR trailing stop loss. So in this case, you can see that this trade is possibly a losing trade. Market breaks out, then reverse back, possibly, you know, stopping you out for a loss on this trade over here. Again, as I've mentioned, right, this isn't a trading strategy that will win all the time. There will be winners, there will be losers. So be prepared for it. Okay, one more example before we move on. Bitcoin. I really want to hammer home this chart pattern to you, this concept. So again, Bitcoin, where is the range? So again, identify a range with at least 80 candles. Okay, this is the highs of resistance. You want the price to approach resistance and form a build up. So we let the 20 MA be our guide to let us know that the market is about to break out. You can see that over here, 20 MA has touched the lows of the build up. In fact, you can see that's more of a higher lows into resistance, otherwise known as an ascending triangle. Okay, then now the 20 MA has touched the lows of the build up. You can place a buy stop order above this highs over here or above this highs. And if the market breaks out, 3 ATR as your trailing stop loss. So in this case, market breaks out, 3 ATR trailing stop loss is this blue line over here. Okay, and you will hold this trade until the price breaks and close below it. Does it make sense? Okay, so I share with you quite a number of examples. Hopefully now this, you know, pattern is kind of, you know, burned into your brain. So moving on, tweaks and modifications. So this BWAP trading strategy is not cast in stone. It doesn't mean that you have to follow the exact rules that I've shared with you. No, that's not how it works, right? And I don't want your trading strategy to just simply replicate exactly, right, what I teach. I want you to think on your own. So a couple of things that you can consider and modify. Number one, adjust the trailing stop loss. So depending on the type of trend that you want to capture, if you want to capture a longer term trend, you can use 4 ATR or 5 ATR as your trailing stop loss. But bear in mind that the wider your trailing stop loss, right, your position size on the trade will be reduced accordingly. If you still want to, you know, maintain your, say, 1% risk on each trade. Number two, you can go with an early exit. So this technique allows you to reduce the size of your losses. So let me explain how this works. So if you recall, previously the dollar against the Turkish lira, the market actually did a false breakout. So you can see that over here, let's say you had a buy stop order, let's say above this highs, market breaks out and next candle it reverses back against you. At this point, it might not have hit your trailing stop loss yet, but you could, you know, exit this trade earlier, an earlier exit to reduce the size of your losses. So let's say your stop loss is over here, right? Instead of letting hit your full 1 hour stop loss, you can exit ahead of time. So you reduce the size of your stop loss. Maybe it's only a 0.5 hour loss or 0.6 hour loss, okay? However, the downside to this technique is that you can imagine that if the market, let's say, if it does, let's say it does reverse back up higher, right? You would have exited the trade prematurely. Okay, so that's the downside to it. So my suggestion is that if you want to use this early exit technique, okay, so let's say over here, you have exited this trade at this point, okay? What you want to do is to be prepared that this market could be just a shakeout, right? Just to, you know, shake out the weak holders. So be prepared to re-enter the trade. So if the market does break back above this swing high, you re-enter back the trade and you know, have your trailing stop loss, right, set again. So this is kind of like insurance, right? Just in case that, you know, if the trend becomes a full-blown trend, at least you can hop on board the trade once again. So for me personally, I just do this a maximum of one time, right? I don't like to, you know, keep doing this this early exit too many times. Just one time, right, is enough for me. If there's an early exit one time, I'll try to get back into the trend, into the trade, right, one more time if the market does breaks back above this swing high. And the final technique that I want to share with you is what I call the pre-breakout. So imagine this, okay? If you look at this chart, market forms a build up over here. Wouldn't it be great, right? I mean, the basic strategy that I shared with you earlier is that if the price breaks above this highs, you enter the trade. But wouldn't it be great that if you could enter the trade before the breakout occurs? Entering the breakout before the breakout? Is it possible? Yes, actually. And I want to share this technique with you called the pre-breakout. So this is the daily time frame. So to execute this technique, right, you need to use multiple time frames. So let's go down to the 4-hour time frame. Okay, so this one here is the daily time frame. Okay, over here. And on the 4-hour time frame, it looks something like this. I just zoom out your chart so you can see kind of like apple to apple, right? This is the daily time frame, price structure, and then on the 4-hour time frame, this is the one over here. So what you're looking for is a false break setup on the lower time frame. the false break setup at the lows of support. In other words, you're looking for rejection of lower prices at support, which is over here. So if I just zoom in a bit, you can see where this price rejection occurred. So over here, you can see that this is the area of support. We have this price rejection where the price heads down lower into support and then close bullishly back into the range over here. So this is what I call a false break setup, and you can enter over here on the next candle open. Stop loss 1 ATR below this low, say somewhere about here. And if you look at it from the grand scheme of things, right, you're actually buying right near the lows of this build up over here. So you're entering the breakout before the breakout. And if let's say in this case the market did break out, your risk to reward on this trade is like, ooh la la, really, it's going to be really, really favorable for you. So this is an advanced technique, I admit, right? But spend some time to understand this concept, how it works, and it will pay dividends in the long run. Okay, so that's a few tweaks and modifications that I have for you. And pros and cons of this trading strategy. First thing, right, you have low risk and pretty high reward, because if it becomes a full-blown trend, right, you know, you can actually ride the trend and your risk to reward is favorable, 1 to 3 or even more. The downside to this trading strategy, right, to the BWAP trading strategy, is that your opportunities are few. Let's say you only trade the Forex markets on a daily time frame. You won't have many trading opportunities in a year. So this is why it's important, right? If you want to trade this, it's best, right, to diversify, look into stock markets, the futures market, so you have more trading opportunities. And again, the concept is the same, right? Whatever I just shared with you, right? The 4-step technique, right? Identifying the range, price approach the highs of resistance, 20 MA catch up with the lows of the build up, and then, you know, placing your order and trailing stop loss order. So recap, right? Today you've learned about the BWAP trading strategy, right? I mentioned with you, right, a few tweaks. You can adjust your trailing stop loss to, I mean, if you want to ride a longer or shorter term trend, you can use the early bailout technique to reduce the size of your losses. And finally, we talk about the pre-breakout technique, right? Entering your trade right before the breakout occurs. And then we talk about the pros and cons of this as well. So if you really enjoyed this trading strategy and you want to learn more stuff like this, right, my suggestion is to go down to my website, tradingwithrayner.com over here, and you scroll down to the bottom. There's this guide over here called the Ultimate Guide to Price Action Trading. I'll share with you a reversal trading strategy that you can trade, how to better time your entries and exits, right, price action stuff, and much more. So click this orange button. I'll send it to your email for free. And with that said, right, if you've enjoyed today's training, smash the thumbs up button, subscribe to my YouTube channel, and I will talk to you soon.